All right. Today is Tuesday, March 8th. This is a recap of the stock market activities today. Folks, I got a good one for you tonight. We're back. If you did not check the macro analysis of the Russian sanctions, please go ahead and check out that video. But for this video, we're going to talk about what happened in the stock market today. And right off the gate, in the last few days, we've been seeing the same theme over and over and over again. Oil futures shoot up higher, significantly so overnight, to the point where stock market futures start to dive down dramatically. And then, right before the open, we see a mysterious phenomenon where oil futures drop down and stock market futures shoot up higher, aka the plunge protection team. Busy, plunging. And so far, they've been losing. But today there was another mysterious reversal midday, and it was big time buying, relentless, over and over again, producing a massive candle higher. Many explanations for why this happened. Number one, they're saying perhaps it's on the news of European stimulus. Now we're talking about more stimulus. We already have an inflation problem, but they're talking about stimulus. And the assumption is if the ECB and European countries do stimulus, we're gonna do it here in the United States. This is delusion and complete insanity to do another round of stimulus right now to offset the self-inflicted wound of higher gas prices. The reversal midday happened pretty much a few minutes after the announcement by the Biden administration of imposing an embargo on oil and gas from Russia. My explanation to all of that is the following. We could have seen the knee-jerk reaction of buy the rumor, sell the news, meaning a lot of traders attempted to play the psychology game where they assumed, rightfully or wrongly, that the moment we get the announcement, the official announcement that we have an embargo on Russian oil and gas, we will see dumping of oil futures and contracts and a rotation back into the equities market. My hunch is after they attempted that and they dumped oil and they bought the dip in the equities market, specifically in the losers, airlines, semiconductors, software, all of the losers, and dumping the winners, energy, metals, fertilizers, staples, defense stocks. I believe midday they realized that they're wrong. And they started fading the rip right away. Because again, the technicals are one thing. Yes, the technicals in oil, gold, wheat, palladium, all highly extended, begging for a reversal and perhaps a correction, but the fundamentals remain extremely strong. You're gonna ban a massive portion of the oil output in the globe. You think this is the end of the rally in oil? Think again. And if oil continues to rise higher, inflation expectations will continue to move higher, prompting the Fed, whether they like it or not, to be more aggressive on tightening the monetary policy. And this is exactly how stock market rallies end and recessions start. Speaking of recession, here are some indicators, and grab a diaper or two, by the way. You're going to need them. Here are indicators that will pretty much seal the deal that we have a recession in the bag. It will happen sooner or later. Guaranteed. 1,000,000%. Indicator number one, look at the Russell 2000 versus the S&P 500 in blue. This is the performance of small caps versus the larger S&P 500. When the blue line in the chart dips down, it means that the Russell 2000 is underperforming the S&P 500. In an expansionary phase of any economy, you want to see the Russell 2000, the small caps, outperforming and leading the S&P 500. What are we seeing so far? The Russell 2000 is lagging the S&P 500 big time. And then we have in orange the ISM manufacturing PMI. And every time this one dips down, it is an indicator that we have a recession. And finally, as you can see the shaded gray area on the chart, these are the periods when we saw a recession in the economy. And the pattern is clear. The leading indicator is when the Russell underperforms the S&P 500. And then what happens? The ISM manufacturing PMI starts to dip down. And soon enough, a recession follows. Indicator number two. Every bear market, as you can see, tended to foreshadow recessions. Every time we get a bear market in the S&P 500, we got a recession right away. It is a leading indicator for an upcoming recession. What we have right now is a bear market in the S&P 500, but primarily the Nasdaq. So we're getting closer and closer and closer to a recession. We're not out of stagflation yet. I believe that stagflation will intensify. And then, as stagflation starts to get out of control and the Fed remains in a coma, so callous, asleep for all what's going on, they're gonna wake up from the coma and slam on the brakes so hard to the point where the economy is going to crash and dip into a recession. And perhaps the most accurate indicator is the yield curve in the bond market. And as you can see, we're already getting closer and closer and closer to an inverted yield curve. And this has always been a leading indicator, an accurate one, that a recession will come in the following year. And therefore, the CPI reading that we're about to get this week, but most importantly, the FOMC decision from Jerome Powell this month, whether this economy dips into a recession or not. If Jay Powell acts as he should by taking inflation seriously and raises interest rates by about 50 basis points, it will send a clear message that the Fed is serious about tackling inflation. And while we have a hot economy right now, an expansionary economy, perhaps at the later phases, the economy is primed to take the blow. The economy can take it. Yes, there will be an impact. The economy will slow down dramatically. Perhaps we might start to lose some jobs. But the risk is if you wait for too long, then it is inevitable that at some point you're going to slam the brakes so hard, so aggressively when the economy is already damaged and it's already slowing down, and hence creating the recession, if not the depression. We will continue to talk about the inflation theme in the commodities market coverage, but we have to start by covering the indices performances today. Let's do that, and here we go. The Dow Industrial Average closed in the red, down 184.74 points, or a decline of 0.56%. The Nasdaq was down by 35.41 points, or a decline of 0.28%. The S&P 500 was down by 30.39 points, or a decline of 0.72%. It was a roller coaster day. It appeared that we're out of the woods, and it turned out to be a bull trap, and the indices closed pretty much closer to the flat line. What about the sectors' performance today? Leading the pack at number one, capturing the gold, the silver, and the bronze. Energy. Yes, we had certain sectors that also closed in the green, but it was a pathetic performance compared to energy. The laggards of the day were led by defensives, healthcare, and materials. We're seeing a change here. Cyclicals moving higher, technology moving higher, financials moving higher, materials moving down, defensives moving down, utilities moving down, REITs moving down. What does that tell you? The market is ready and primed for a change, meaning finding a bottom and rotating to the growth trade once again, the cyclical trade once again. But energy remains a problem. Why? Why is energy continues to lead? Because crude oil prices continue to move higher. So this is the sticky point for the bulls to initiate a rally right now. What about the advance to decline ratios? NYC 54% advancing versus 42% declining. The Nasdaq 52% advancing versus 42% declining. And again, look at the 52 weeks highs versus the 52 week lows. 449 names in the Nasdaq today made a new 52-week lows versus only 31 that made a new 52-week high. This is a bear market. It is unquestionable right now. Moving on to commodities futures. Believe it or not, both the WTI and Brent closed well below the highs. But even with that, the WTI closed the day gaining 4.5%, while Brent gained a little over 5% today. Likewise, massive surge in gasoline prices, over 4% today. But look at heating oil, unbelievable. 15.45% in the green today. Natural gas was down by about 5%, but the action is actually in natural gas prices across the Atlantic. London gas prices were higher by double digits today. What about softs? We have a down day for lumber, losing about 4% or so, yet we have a rebound in coffee. It's about time because coffee has been the laggard, at least for the last few weeks. Coffee futures closed the day gaining almost 3.5%. Likewise, we have gains for cotton, OJ, sugar, cocoa, be it modestly. What about metals? The gains continue. Massive gains for gold, over 3%. Silver, over 4.5%. Platinum, over 4.5% gains today. Palladium, the poster boy for what's going on right now, gaining another 8.5% in today's session. The laggard remains copper. Copper is down by almost half a percentage point. What about meats? We have decent gains, a little below 1% for live and feeder cattle futures, while the new big tech rallying higher again and gaining a little over 2.5% today for lean hogs. What about grains? Again, all eyes on wheat. Wheat was limit down today. It was limit up for a few days now, but today was limit down, and then after the reopening, wheat closed to the downside by about 1%. So it rebounded higher from limit down. The other loser was rough rice. Rough rice was down a little over 1.5%, but we have massive gains for soybean meal, soybeans, soybean oil, all gaining tremendous gains today, while we have modest gains for corn, oats, and canola. Let's do some commodities news. And in this case, starting with aluminum. As you can see, we have an arbitrage opportunity here because European consumers are paying more for aluminum prices versus Asian consumers, for example. We have the LME spot aluminum price, as you can see in white, but the Rotterdam aluminum prices are trading at a premium. So there is an arbitrage opportunity. It's always been that case, but the gap is widening. And this is due to the impact of the shortage in the Russian supply to the European market. And as you can see, when we look at the Shanghai aluminum prices, they're dirt cheap when you compare it to the LME London aluminum. So there is a lot of arbitrage opportunities across the board. European prices are moving higher, Asian prices are moving down. But the bet is for now that aluminum prices will remain elevated for the long run. And the reason is the supply is nowhere to be found. Inventories are running at critically low levels, specifically in Europe and the US. The supply remains ample in Asia and Shanghai, which gives the Chinese a critical advantage over Europe and the US. You think we can sanction China? Of course not. But about food and grains, the food price index, the UN food price index, has reached all-time highs. This is disastrous. This will cause starvation crisis across the globe, but your leaders don't care at all. And these sanctions and the war between Russia and Ukraine will cause a severe shortage of wheat, corn, and other grains, and the poorest countries in the world will pay the price. We have warning that the Russia-Ukraine war could bring a biblical event, quote unquote, as the global wheat supply is being disrupted right now as we speak. What are they talking about? The Russia-Ukraine war is fueling the biggest supply shock in global grains market in memory. We've never seen such a shock in history, at least in modern history. You hear about famines 100 years ago, a few hundred years ago. But can you imagine that we are on the brink of a starvation crisis, perhaps a famine? In the 21st century, yes, because this is what we're looking at right now. Matter of fact, the bread basket for the globe is Brazil. Brazil produces all kinds of agricultural products, coffee, soybeans, corn, but they don't produce fertilizers. They rely on other nations for fertilizers. Guess what countries Brazil imports fertilizer from? Well, we have Russia, about 22%, and Belarus, 6%. Both of these countries are under sanctions, so you have about 30% of the fertilizer supply for Brazil being disrupted. This will cause severe shortages in grains and indeed will intensify the starvation crisis. Now, what about the US production? Perhaps the US can save the world by producing more. Well, the USDA projects that US wheat production this year will be at 1.977 billion bushels. This is below the 5-year average. Meanwhile, Russian and Ukrainian supply, the two largest exporters of wheat, will be off the market for at least months. Wow. Moving on to the options market, the big casino, what's going on here? We have some elevated volume for Apple. Apple led the action in the casino, the hottest table by far, with around 1.4 million contracts traded today. About 59% of those were calls. And at number 2, Vale. Miners are surging, nickel prices are surging, copper, iron, all of them moving higher. But this name is also paying dividends tomorrow, I believe, and therefore it traded about 700,000 contracts, about 96% of those were calls. At number 3, Tesla, the souffle, with a little over 600,000 contracts traded for the name today, about 56% of those were calls. And by the way, say a prayer for those who bought calls or puts on the RSX or any Russian ETF. I warned you they're going to halt trading in these, and this is exactly what happened yesterday. Even if you did the right call and you bought puts in the RSX or any other Russian ETF ahead of time, you couldn't even get out because there were no buyers. So we're sitting on paper gains with no buyers to hold the bag. I'm also watching the implied volatility of options, and whether we're talking about Apple, Tesla, AMD, Chevron, Amazon, all of these names are trading above 90% in the IV percentage. What does that mean? In a typical market, the implied volatility was surging higher on the downside, as these names were selling off. With exceptions, of course, like Occidental, Exxon, Chevron, the implied volatility was moving higher as these names were moving higher. Usually, this is a contrarian indicator, saying that the move that led to the elevated implied implied volatility should reverse, meaning Occidental Petroleum, for example, has been skyrocketing higher. When I see the IV percentage at 100%, this is a sign that we're getting closer and closer to the top. Another name, let's say like American Airlines. The IV percentage is around 100%. On the downside, the name has been crashing. This is an indicator that the name is about to reverse and perhaps move higher. The problem is this is not a typical market. This is a bear market. This is a market that's being hit pretty much every single day with a new batch of bad news. So there is a lack of certainty in any of these moves. But the risk versus reward says if you've been riding Occidental, if you've been riding Chevron, you should start thinking about taking your profits. If you've been riding names like American Airlines to the downside, you should start thinking about closing these positions and booking your profits. Moving on to the unusual activities that took place in the options market today, we start with the ticker ASHR. This is for the Chinese ETF, down big for the year, but somebody's buying the dip here via buying calls. The 36 calls for the expiration date, April 22nd, with the expectations. The name could pop higher by more than 6.5% by then. They paid about 40 cents a piece to enter this trade, all in all spending about $3.4 million. What about the ticker SPY for the S&P 500? They're buying puts this time around. The 355 puts for the expiration date April 8th. With expectations, the SPY could drop down by more than 15% by then. They paid about $2.35 a piece to enter this trade, all in all spending about $5.8 million. What about the trade for the ticker GLW for Corning? The buying calls, it's a value name. It is an inflationary stock. They have the pricing power. The problem is it is lumped in many technology ETFs, so when these go down, this name also goes down with them. But somebody's buying calls here, the 42 calls for the expiration date May 20th. With expectations, the name could pop higher by more than 13.5% by then. They paid about 85 cents a piece to enter this trade, all in all spending about $1.5 million. What about the ticker NVDA NVIDIA? Pay attention here. Palladium almost went down today, and they were buying some SMH calls yesterday on the semiconductor ETF. This is a short-term trade with only 3 days till expiration, so they're betting for a bounce. I'm seeing this theme yesterday and today. They're betting for a bounce on the losers, NVIDIA, the technology software names, the winners of last year. In this case, they bought the 230 calls. The expiration date this Friday with expectations that NVIDIA could pop higher by more than 7% by then. So this is a bet for an expectation of a dead cat bounce, a bear market rally, an oversold rally, whatever you want to call it. But I'm seeing these bets increasingly right now. Anyhow, they paid about $1 a piece to enter this trade, all in all spending about $1.3 million. And lastly, what about the trade for the ticker PM Philip Morris? It has been a house of pain as of late due to the exposure of the company to the Russian market, but it has been a house of pleasure for yours truly, the guy you're listening to right now, because I showed it exactly at the top and I shared the trade here in this program. Today, I closed all of these puts. It has been a profitable trade, but it became really oversold, and somebody's now betting for a rebound by buying the 100 calls for the expiration date, April 14th, with expectations that Philip Morris could rebound higher by more than 6.5% by then. They paid about $1.25 a piece to enter this trade, all in all spending about $1.2 million. Moving on to the heat map analysis. Look at this. It's a mess. It's all over the place for a reason. Because I believe that traders attempted to sell the winners and buy the losers. For example, let's look at the winners. Defense names, Raytheon, Lockheed, Northrop down big. NOC was down over 6% today alone. What about agricultural names? Mosaic down big today. The big pharma dividend names also down big today. The consumer staples also down big. Coca-Cola, PepsiCo, Procter & Gamble. Now, there are some fundamental news that I'm going to share with you in a minute, but it is really interesting. The winners today were the cyclicals, cruises, hotels, casinos, airlines, Caterpillar, the financial names, not all of them, but the regional banks performed today. Some of the software names, chips moved higher. They were significantly higher midday, and then they started to sell off again. The only sticky winner that also won today is energy. Chevron specifically was up over 5% today. So are we seeing the beginning of the rotation from winners to losers? Perhaps, but we have to confirm that with the fundamentals. We have to see oil prices down. We have to see palladium, wheat, gold, the dollar, all going down. Absent of that, we have to assume that what we saw in the last few weeks will continue to go on. And here is some news for the notable movers today, specifically related to Russia and the boycott, suspending operations, whatever it is, doesn't matter. But perhaps this explains the weakness in consumer staples today. McDonald's was under pressure over the weekend. You might have heard the hashtag boycott McDonald's. Why? Because McDonald's has been operating in Russia, bowing to the pressure, and I don't blame them, by the way. It is what it is. Today, McDonald's said we're suspending all operations in Russia. Now, mind you, Russia is about 9% McDonald's revenue. This will be a massive hit. We're talking about almost 10% of the revenues for the entire company. You can look at it one way and say, hey, come on, it's just 10% of the company's revenues. No big deal. But you can look at it from a stock market perspective. What if a company loses 10% of its revenue in a quarter? Let's say in an earnings call. The stock crashes right away. So McDonald's is toxic right now. Starbucks came out today with the same story. They're pulling out of Russia. Small portion of the revenues, but again, any company that reports revenues down 5-10% in a single quarter, stocks crash. More of these boycotts. Philip Morris, not really a boycott, but Philip Morris has a massive operation in Russia, perhaps the biggest exposure in the S&P 500 to the Russian market. JP Morgan downgraded Philip Morris, and I've been short the name. It has been a great trade, but I had to cover it today. Number one, why be too greedy? Number two, what if we have a technical rebound in the stock market? What if we have some good news regarding the Russia-Ukraine front? This will initiate a short covering rally. Most importantly, the number one rule in options trading right now is always be closing. We have Netflix also suspending services in Russia. The stock is down big. Airbnb, similar story. The stock is also down big. Visa, suspending operations in Russia, also down big. MasterCard, similar story. American Express, perhaps bearing the brunt of the pain because they have more exposure to the Russian market, and they're down big. PayPal also suspending services in Russia. I'm waiting for Pornhub and OnlyFans to suspend services in Russia. They will go down to zero right away. But anyhow, even Honda, we've been talking about Honda in this program for a while. It has been a performer for the year, not anymore, because they're suspending sales in Russia. Yes, we have good news. Honda remains a value name. We have a collaboration with Sony for an EV. The problem is we're having this massive tsunami of selling. The good, the bad, the ugly. Any company that suspends sales in Russia will get hit hard. It is a small market, granted, but we're talking about a portion of the revenues gone entirely from these companies. And you wonder why the stocks are down? And then we have Occidental, the winner last week, Occidental Petroleum, that is. The news, Icon out. He's been in the stock for a while now, taking profits. The stock, I believe, is all-time highs. So Icon is taking the opportunity and ringing the cha-ching button while we have the big Buffett buying from the hands of Icon. $5 billion stake in Occidental Petroleum. That tells you he likes the value. He sees higher oil prices, and he sees these high beta names, Occidental specifically, moving significantly higher. We're not done with the gains. For you and I, the non-Buffetts of the world, if you want to build a stake in this company, you gotta wait for the dip, because for now it's way overbought. If you buy it right now, you're gonna get a nice haircut of 10, perhaps 20% to the downside. But for now, Berkshire Hathaway, as we predicted by the way in this program, will outperform the S&P 500 and the Nasdaq, and Warren Buffett might reclaim the title of the richest man in the world. For now, Berkshire Hathaway is getting closer and closer to overtaking Tesla in market cap, meaning the big buffet will be richer than Elon Musk. We also have a notable mover from yesterday's action, and even today, a massive pop. Bed Bath & Beyond, and the reason is, it's a silly reason to begin with, but we have GameStop CEO Ryan Cohen, who bought a stake in Bed Bath & Beyond. Now, what is he going to add to the company? Maybe Bed Bath & Beyond will start selling bath salts, because that's the only thing I'm buying from Ryan Cohen. I trust this guy with drugs all day long. Look at him. He knows where the good stuff is. Moving on to the heat map for the ETFs. Again, a mixed picture. Energy's holding on. But look at what's moving higher today. SOXX, SOXL, chips moving higher. XRT, cyclicals, retail moving higher. We're seeing the IWM leading the gains versus the Qs, the SPY, the Dow. The IWM is a leading indicator. So this begs the question, are we going to see the rotation from value to growth? Rotation from the recent winners, the recent losers? Look at the XLP, consumer staples, down big, over 2.7%. Value was down, so was growth. But growth outperformed value today. Is this a leading indicator to what's about to come? We'll see. Now, when we look at international markets, the recent losers are moving higher. Primarily European ETFs, the VGK EZU, EWG, all leading the gains today. We also have India, a recent loser, moving higher, the ticker INDA. The winner so far for the year, the EWZ, still in the green, but underperforming the European ETFs. And the problem with the EWZ today was Petrobras was down big because Bolsonaro once again is attacking the company. Every time we have higher oil prices, he attacks the company. What are they going to do? They're trading the commodity in the open market. They trade it at the market price. They have no power at all in controlling prices. But again, this is what politicians don't understand. They think the oil companies have the power to make up the price. This is not the case. We also have the EWC for Canada, which is really interesting. It has been an outperformer for the year, by the way, but the Canadian economy is surging right now. Canada is enjoying a surplus for a long time. The last time we've seen the Canadian economy enjoying such surplus, it was back in the inflation of 2007-2008. Canada produces a lot of oil, lots of nickel, palladium. In other words, Canada is a replacement for Russia. Whatever you find in Russia, you can find in Canada and then some. Canada is way richer than Russia when it comes to resources. So this is one economy that's going to continue to benefit from this inflation. Now, do you buy the EWC altogether? Not really. I'm against it because you have a lot of exposure to banks. Banks will get hit hard with these sanctions and the slowdown in the global economy. So look at Canadian miners. These are the names you want to buy. Canadian miners, lithium, nickel, palladium, and oil and gas companies in Canada. Look for individual names within the Canadian market. Moving on to charts, and we start with SPY 30 minutes chart for the S&P 500. As you can see, the support of 422 was gone in the morning. So we were looking down at 410.5. This is my number. Not buying the SPY until I see a rebound from 410.5. Or if we see a closing above 430, the line in the sand. Absent of that, not buying the SPY. Because what if what we saw today is merely working out some oversold conditions on the RSI? We got the pop. The oversold conditions are gone. And then what do you know? Here comes the reversal, the bull trap, and we close pretty much at the lows of the day. Not buying this one right now. We don't have any signal that we got a solid reversal. Now, had the chart closed above 422, then we're talking. We could have said, okay, this is the beginning of a reversal, perhaps a bounce. We'll see what happens at around 430. If that is recaptured for support, then we buy, but not for now. What about the continuous contract for the SPY? This is a daily chart. Again, the support of 4,232 is gone, meaning you're not going to buy until you see a rebound from the double bottom at around 4,102. The momentum indicators are curling down. They're in negative divergence once again. The volume spiked higher on the selling side. It was actually some buying and then some selling, so it is inconclusive, but the bears remain in charge. You want to watch this level, 4,102. And you want to combine that, preferably if you have two charts on the screen. You combine that with the VIX, and if we have a solid reversal in the VIX, losing 33 as support, then you have a solid signal to buy. You combine that with perhaps oil futures trading down, gold, dollar, palladium, wheat also moving down. Then you have a confirmation that things are changing, but not for now. What about the Qs? The Nasdaq 30 minutes chart. Again, it got really oversold in the RSI. We got the bounce, and the bounce did not live for too long. Now, you could say, what if this is a bull flag formation? Not really. You close pretty much at the lows of the day. Why couldn't the chart close above 334 if it was such a reliable, strong bounce? I feel it was a plunge protection kind of bounce, and it did not work. Not buying until I see 316.46 as a reliable bottom, or we see a recapturing of 343 as support. Absent of that, the Qs remains bearish. What about a daily chart for the continuous contract on the Nasdaq? Why do I have 1, 2, 3? I was supposed to do a show yesterday. These are my notes from yesterday, but let's catch up. Number 1 is support number 1, which is the trend line in yellow, as you can see. And today we got a bounce exactly from that. If that doesn't hold, then we have support number 2, which is the low of the last bottom, which is around 13,026. And then if that doesn't hold, we have the last support at around 12,766. If that doesn't hold, then cue the Elmo with the fire, cue the nuclear bomb, cue the end of the world. For now, the momentum indicators are still within negative divergence. The volume spiked higher on a down day. All of these are good signs for the bears that perhaps we have more pain to come. But we haven't seen the bottom in this chart yet. Keyword yet. What about the IWM small caps, the Russell 2000 30 minutes chart? We had a pop, a recapturing of 196.5. So far, so good. The problem is, it lost the support right away. It closed the day below that support. If the chart was ready to trade above 196.5, why couldn't it hold today? That tells me that perhaps the chart is looking down at 191.5, and then that might be a more reliable bottom to bounce from. But if you place your bull's shades on, you could argue that this is perhaps a higher low. The problem is, you cannot say it is a higher low because the last candle of the day closed pretty much all the way to the downside. We did not see a pop by the end of the day to assume that this is a higher low. What about the Dixie, the US dollar, a daily chart? Again, it isn't a breakout. Yes, the technicals are way overextended. Both the RSI, the MACD, in typical charting behavior, we would have said you gotta fade this chart. Take your profits, wait for a reversal signal, and then start shorting. The problem is we are in an unusual market right now. You cannot assume that. You gotta wait for the chart to show you the top before you start shorting or fading. Of course, you're not trading the US dollar, but as the dollar continues to move higher, equities will be under pressure because a higher dollar crushes the margins, specifically for the big international companies. But if the dollar cools down, then we have perhaps a signal that we should buy the dip in the NASDAQ and the SPY, specifically the multinational names, not related to Russia, of course. What about gold? Again, it's in a breakout. Look at that. It touched pretty much exactly to the penny the previous high from August of 2020. Not quite, but it got really close. It could give it another shot. It is on a breakout. You ride the ride until it's over. And for now, we have no indicators at all that it is over. But we have indicators that tell us we're getting closer to that point. The RSI, the MACD, way overextended. The last time around, we saw the MACD and the RSI at these levels was exactly the spike top of August of 2020. So what do you do if you've been riding gold? You take profits. What do you do if you're waiting to short gold? You wait for a reversal signal, a solid one. What do you do if you have FOMO and you want to ride gold higher? You stay on the sidelines or you buy intraday contracts, in, out, hello, goodbye. You make a quick profits and you close. The problem is all of these options right now are elevated in premiums, so you're kind of too late to the game. You're better off waiting on the sidelines, waiting for a dip, a reliable dip, and then get back in. And by the way, we have more tailwinds for gold, because we're now looking at sanctioning the $132 billion in gold reserves that Russia has. If that happens, we're going to push gold values higher and higher and higher. What about the 10-year yield? We have what it appears to be a double bottom at around 1.7. The RSI, the MACD are all curling higher. Is this an indicator that the 10-year yield is about to pop higher again and forget about going down to 1.55? It certainly appears to be the case. Inflation expectations are moving out of whack. We're about to get the CPI this week. If it comes out too hot, then the 10-year yield will surge higher on expectations that the Fed will have no other choice but to become too hawkish right away, right off the gate. The problem with this chart is it is an indicator for many things. The 10-year yield can go higher on higher growth expectations. The 10-year yield could go higher on higher inflation expectations. The 10-year yield could go higher on interest rate hike expectations. So you have to decode the message. And for now, the 10-year yield is moving higher after we saw the move in nickel, in palladium, in wheat, in oil. So it is moving higher based on higher inflation expectations. And hence, the TLT was down. This is a weekly chart for the TLT. It lost the support of 140. What a disappointment for the TLT bugs. It looked really promising. You had higher than average volume on the buying side last week. You had the RSI, the MACD indicators curling their way higher, about to break the negative divergence, but then it stopped. Really heartbreaking for the TLT bugs. But again, it is a losing trade. It has been a losing trade for a long time. Why place all your money and your bets on this one? This is an old, dying horse. It's not going to be a sexy one again. What about the VIX? 4 hours chart, again, talk about confusion. The triangle pattern broke to the upside. We have 33 as support for now. But look at the MACD indicator. Is it about to cross to the downside? Who knows? I could see the MACD indicator curling its way higher and accelerating the upward momentum. I could also see the MACD indicator is about to cross to the downside, ending the pop in the VIX, losing the support of 33, and then we have a reliable bottom in the SPY. It could go either way, so we have to wait till we get the action from tomorrow's activities. If the VIX recaptures 38 as support, then you have a reliable signal that the VIX is not done. We have more pain in the SPY. If the VIX loses the support of 33, then it is a good signal that the rotation from recent winners to recent losers will happen. And here it is. What about the VXN, the VIX for the NASDAQ? Different picture entirely from the VIX. As you can see, the MACD indicator is accelerating to the upside. The gap between the white and blue line, the average, is getting wider. This is a good sign for NASDAQ bears that the pop in the VXN is not over yet. We're eyeing 40 as the next resistance. What about Apple, the daily chart? It went down all the way to my number, 1.57. That is the support on higher than average volume on the selling side. The assumption for now is, looking at the volume, looking at the MACD indicator, look at the RSI. The assumption for now is we're going further to the downside, absent of a reversal signal, which we don't have yet. Keyword yet. What about Tesla, the souffle in hourly chart? It has been the outperformer in the NASDAQ in the last few days, and for now, we have a sloping line of resistance that Tesla is struggling to break above. Are we seeing a bull flag formation, meaning that Tesla will pop higher, breaking the sloping line of resistance? That appears to be the case for now, but until that happens, we are in no man's land. The bulls are waiting for the pop to ride it higher all the way to the trend line in yellow, which is around 900 or so. The bears are waiting until the chart takes out the lows of 728.5 before they start shorting again. And here's some souffle news for you. Today we got the number from the Shanghai production, and it was down, but pretty much every single manufacturer was down too, month over month. Yet Tesla was up year over year. So the stock did not care at all about these numbers. The problem for Tesla right now is that we're seeing massive inflation in metals, lithium, nickel, cobalt, aluminum, copper, meaning the prices of these cars will continue to go higher and higher and higher unless Tesla wants to accept lower margins, because this will crush the stock. Lower margins means lower stock. We've been giving the excuse for Tesla to trade out of whack when it comes to valuations because the growth has been intact. You take the growth out of the picture and you could see the stock diving down dramatically. And again, this is a classic mentality of retail traders and investors. They look at oil prices moving higher and they say the alternative is EVs and green energy. So you gotta buy those. They've been buying solar. They've been buying Tesla. The problem is, yes, we have an inflation in oil prices, but we also have an inflation in metals prices. So either way, oil moving higher, and the prices of EV and solar also moving higher. It is a lose-lose situation. You lose either way. And even Tesla CEO Musk, Reverend Elon Musk, came out and said that the US and the world should pump more oil. He said it will be bad for Tesla, but it has to be done. He's been attacked, by the way, for saying that. And then he got in more trouble by saying that Starlink will not censor RT, Russia Today, because he is a free speech absolutist. And he got attacked for that. And then Reverend Elon was demanded by the Twitter mob to deactivate all Teslas in Russia. Now, are the drivers of Tesla all Putins or regular folks? Why would you deactivate their Teslas? This will be a PR disaster, the reputation of this company. But the mob, of course, the sheep, are completely clueless. They follow whatever the current issue is. And then Elon got in more trouble today. He asked to end the 2018 settlement with the SEC, saying that the SEC is gagging his freedom of speech. So Elon has been busy, along with Tesla. We also have some good news for Tesla. The Berlin Gigafactory was approved. Panasonic is moving to the US with another factory to supply Tesla with batteries. But the main problem remains the inflation in aluminum, nickel, lithium, and cobalt. You cannot get around that. At some point, either the company has to raise prices or they're going to have to live up with lower margins. Hence, the growth story goes out of the window. Moving on to BTC tulips. What's going on here? Not good. What if what we're seeing right now is a bear flag formation? You're not going to buy this chart absent of two things. The support of 42,000 is recaptured and the triple top is gone. We're trading above the triple top. Absent of that, you're not going to touch it. And oh, by the way, your boy Joe, he wants to sign an executive order to expand the oversight on the $2 trillion cryptocurrency market because they're going to blame it on the Russians now. They're going to say that the Russians are circumventing the sanctions, and hence we have to crack down on cryptos. This is not the real reason. They've been eyeing a crackdown against cryptos for a long time. This is just the smokescreen. What about AMC? We have a rebound from oversold conditions on the RSI. The assumption is, looking at the chart right now, that the rebound should continue for a little while. The problem is, how can you guarantee all of that when we have such a wild market? When everything goes down, when they're selling everything, they're also dumping AMC. But you're doing the right thing from a technical standpoint. If you bought calls today, you did the right thing. I cannot guarantee whether it's going to play out or not. And here are some bonus charts for you. We start with the ticker JETS. We've been talking about jet fuel prices moving higher. Airlines got whacked this week so far. So let's go back to what I said about jets a few weeks ago, maybe a few months ago. And lastly, what about the chart of the ticker JETS, JETS? This is the airlines ETF, a weekly chart. What's going on here? I don't like it because it is forming a head and shoulder formation, and perhaps the destination will be closing the gap you can see clearly on the chart. So we're avoiding airlines for now. Let's see what happens after closing the gap, because we have another gap below that. You combine the thing, the Pokemon variant, with an aggressive Fed that's about to raise interest rates higher, and you have all of these airline companies heavily indebted. What do you think going to happen? Here's the update for you. The chart went down about 22% since that time. It closed the gap, and now it is becoming oversold from a daily chart perspective. So we could see bounces, a dead cat bounce here and there, but the long-term trajectory remains this is going to go down. It will perhaps go down, retest the lows from 2020, and then we'll take it from there. We have a lot of troubles for the airlines. Another chart for the ticker CNC. This is a Canadian stock, Canadian nickel. This is a weekly chart. We have the resistance at around 4. Nickel prices are exploding higher. The moment this chart starts to trade above 4 and closes above 4 on daily charts perspective, it's going to go higher. It's going to pop perhaps to 4.5, even 5. We also have Glencore. This is a monthly chart perspective. As you can see, we have the double bottom and then a massive rebound higher. We're now eyeing the resistance at around 12.79. If the chart starts trading above that number, then we will see a rally to all-time highs. But do you jump in and buy this chart right now? It's really risky. The reason is it is becoming way overextended on the RSI and the MACD. But in typical charting behavior, a breakout above the previous resistance means the chart will go higher to challenge the next resistance, in this case, the all-time highs. And lastly, what about the ticker LAC, Lithium America? We've been talking about lithium prices moving higher. This is a name that appears to be bottoming. This is a chart that reminds me of the chart of gold right before the pop. You have a sloping line of resistance, and then you have a formation of higher lows. As if the chart is saying it is bottoming, it is ready to pop above the sloping line of resistance. And the fundamentals, by the way, support all of that, because lithium prices are surging out of whack in an unbelievable fashion. So why couldn't this stock follow through and also pop higher? I believe it will. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the JOLTS, job openings and job quits. I believe the quits will start to cool down, but so will job openings. And if that happens, what will be the response from Jerome Powell? Is the reduction of job openings an indicator that we have reached maximum employment as Jerome Powell would like to see? Perhaps. But until then, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.